Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in this video, we're talking about the 5 ways that you can minimize your exposure to risk in the stock market and protect your capital. Now, all investments involve some degree of risk, but
Right.
these are tried and true strategies. So, no matter what's going on, whether it's geopolitical fallout, election uncertainty, or even recession fears that you hear daily, you can mitigate potential losses and protect your portfolio. So, Brian, I want to dive right in with the first tip, which is to diversify your portfolio. Now, this one seems obvious, but we're
Right.
starting with this one because you'd be surprised at how many people put everything in one basket or only invest in one industry or asset class.
Yes, many people do. And some do it on purpose because they may know that industry inside and out. Like the oil and gas investors, for example, they invest in what they actually know.
Sure.
But for the average investor, this might not be the case. So if you want to minimize some risk, consider spreading your investments across different asset classes, industries, and even regions.
Mhm.
This can help reduce the impact of individual stock performance on the overall portfolio. This way, if one investment performs poorly, others may offset the losses. Let's take a look at this chart. Year to date, large cap is up 13%. But what's down? REITs. And they
Mhm.
were down 25% last year. But that's the beauty of diversifying. You take the pluses and the minuses and average them out over time.
So, what do you say to people who argue diversifying reduces opportunity?
I agree with that for the most part. Let's go back to the oil and gas investors. This is all they know. So it makes sense for them to put all their eggs in one basket.
Sure.
Being in the know, they could be well ahead of the market in predicting if oil was going to rise or fall. That's a huge opportunity for them, but it won't work for the average investor.
Okay, so the second way to possibly minimize risk is to invest for the long term because long term perspective reduces the impact of short term market fluctuations.
Yes,
And it keeps you from freaking out every time the market takes a nosedive.
you bet it does. Historically, the stock market has shown an upward trend over extended periods, so staying invested for the long haul could potentially smooth out volatility and increase the likelihood of positive returns. See this example of the S&P 500 over the long term. Since 1984, even with the ups and downs, including the dot-com crash, 9/11, the 2008, 2009 financial crisis, and even 2020, the trend is still upward. So let's say you bought in 1984 and held through today, you're still up substantially.
Yes, you are. All right, so let's move on to tip number 3 to minimize risk. What is it?
Okay, this one's critical, and that is to thoroughly research your investments. Too many people jump into a stock because a friend told them to, or
Yeah.
because they heard it on TV, or even on a YouTube video.
Sure.
Don't ever rely on what you hear. Before you invest, you need to research the companies and or the assets that you're interested in so you can make an informed investment decision and reduce the risk of investing in unsound companies.
Mhm.
You want to basically analyze the financial statements, evaluate industry trends, and stay informed about the relevant news and events. You don't need to pay for expensive software either. I've used Yahoo Finance for well over 30 years, and it's free. Take a look at this example. On this chart, you can see you can analyze from the company insights to the charts of what it has done over time in the history of it, conversations that people talk about on here. And I will tell you, on the conversations, be careful on that because a lot of people like to pump and dump the stock. I
Right.
don't use that very often, but you got the history of the company, the profile, the financials. Every time an earnings report comes out, you can truly check it out. I love using Yahoo Finance.
You know, what's interesting too about doing not interesting, but do your own research because it takes that emotion and that trigger response that we all have to want to get in on whatever's going on.
Right.
Allows you to take that step back
It
and
does.
say, okay, is this actually right for me?
Right.
All right. Moving on to the fourth way to minimize your exposure to risk is to dollar cost average. So let's walk us through this.
Yeah, this strategy involves investing a fixed amount of money at regular intervals, regardless of what the market's doing,
Right.
right? By doing so, you can take advantage of market downturns by purchasing more shares at lower prices. Dollar cost averaging instead of investing in a lump sum all at once can often hedge against risk. But this is only in a declining market, and that's the key here.
It
So
is.
let's take a look at this chart.
Okay.
Michelle, what do you see in this chart?
Well, I see that by dollar cost averaging, you're actually making more money.
But which way is the chart trending?
It's trending down.
It's trending down.
Mm-hmm.
Do you think you would pay more for shares if the chart was trending up?
Yes.
And that's why dollar cost averaging really works well in a down market
Sure.
versus an up market.
A market. Very, very good point. That's the one thing you hear all the time. Dollar cost average, dollar cost average, dollar cost average. But what people fail to realize
Sometimes,
is that it
right?
works better in the down market.
It does, definitely.
All right, let's move on to the final tip to mitigate risk in the stock market, and that is to use stop loss orders.
Yeah, you can implement stop loss orders to help protect against significant losses.
Mhm,
So, a stop loss order is basically an instruction to sell a stock at a specific time when it reaches a certain price.
mhm.
This can help limit potential loss if your stock declines significantly.
Sure.
Here's an example from Motley Fool, and it explains how the actual stock block works. So, let's say you bought a stock at $10 and it started going up and it pulled back a little bit and you say, okay, I can accept a little bit of risk. It pulls back a little bit. Oh, because I think it's going back up. All
Right.
of a sudden it starts going back up. It's like, okay, I'm a good again. But then all of a sudden, maybe a negative earnings report comes out and the stock
Takes a dive.
plummets.
Yeah.
Now you might had a sell order at $9 when you bought at 10. You put that stop loss order at 9. When it passes through that, it's going to accept it as a market sell and it will sell out of that position. And at that time you only take a $1 loss on it.
So that's a wrap for our 5 tips. Make sure you check out a video below that we did on the number one risk to your retirement. The link's going to be in that description. Also, if you like the content of this video, hit that like button, subscribe, and leave us a comment below. What do you do to minimize risk?
Right.
All right, Brian, anything else before we wrap it up? Any parting words of wisdom?
Yeah, just remember to stay informed about market trends, economic indicators, and company specific news that may impact your investments. Regular review your portfolio, open your statements and look at them and prepare to make adjustments if it's necessary.
Sure.
But make sure you avoid making impulsive decisions based on short term market fluctuations. So
And that's easier said than done, isn't it?
it's tough. It's tough.
All right. If you like the content of this video, hit that like button. Don't forget to subscribe. As always, Brian, thank you for this. And thank you to everyone who watched.
Thanks, everyone. Have a great day.